Good afternoon from the floor of the CME. This is Chris Robinson with your Traders Exclusive comment for today, Thursday the 29th. So if you count today and tomorrow, there's 2 more business days in the month of November. Then we get at it in December. I'm going to focus today on the grains, specifically the soybeans, and what is the weekend going to hold. This weekend, of course, President Trump will be heading to South America for the G20 summit and the much anticipated meeting between himself and President Xi of China. A lot of people have a lot riding on the outcome of potential negotiations / settlement. So we'll see. It's Sunday night's trade can be very, very explosive. So where are we? And specifically, you know, when you talk about China's impact on our commodities, it's really had a big impact mostly on soybeans. So soybeans, as we head into this weekend, this being Thursday, where are we? Well, we're at the top of a 4-month, 60-cent trading range. So we're near the top of the range. We've sputtered here quite a few times over the past 20 weeks or so. So the setup is for either, Sunday night when electronic trading turns on, depending on what happens over the weekend with the summit or the G20, we could be sharply higher, sharply lower. So I don't know which way it's going to go. Nobody knows which way it's going to go other than probably President Trump, because he's really in the most superior position he can be. He can end it like that if he really wants to. He created it. We started this back in March of last year, and so here we are. So it's a very, very big weekend. And so how do you play it? The best way I know how to play it, honestly, unless you're willing to risk 20, 30 cents on a gap move in soybeans, and 20, 30 cents is, you're looking at $1,000 to $1,500 a contract. So if you don't want to do that, what are your choices? You can do weekly options. You can do, there are some options which expire in about 22 days. Those are the January options. And that allows you to have just exactly what it sounds like. You have a position on, you spend a certain amount for it. So that would entail being long an option. You buy the option, either buy the put or buy the call, depending on what your preference is, depending on how you think the meeting's going to turn out. And then it's a simple thing. Monday or Tuesday, whenever if we have a big move, that call or put option can be worth quite a bit more or quite a bit less. Where is the danger? Well, the danger is if you sell an option naked. In other words, you don't really own the soybeans, and you're just speculating, and you're selling some option that's due to expire, a week from today, because you can collect a little money. There's an expression for that. It's called, you're picking up nickels in front of a steamroller. If you don't believe me, just, if you've read the headlines in the past 2-3 weeks, there was an options firm that basically went out of business because they had sold strangles in the natural gas contract, and natural gas blew up. And they had these call options they had sold and collected a very little bit on a lot of options. So they collected money, but that position moved against them, and it ended up being a catastrophic event. So I do not recommend selling naked options going into a weekend like this where there's a possibility of a big move. Sunday night trades could be very, very interesting. There's a lot of opportunity there. People always complain when the market's slow and not moving, oh, we need movement. Well, we've got a specific time point on the horizon this Sunday night where we're going to get some sort of movement in the grains. Specifically, I'd watch soybeans because that's the most sensitive to what happens with China. If you're looking for help with your trading, with your speculating, if you're a producer and you're looking for different ways to hedge your business risk, look me up online, Chris Robinson. Have a great day.